Right now, as you're watching this, European leaders are celebrating their unified currency, their economic strength, and their position as the world's second largest economy. They're talking about stability, recovery, and a bright future. But hidden in their own central bank's balance sheets, buried in government debt reports that nobody reads, is a number so catastrophic that when it finally detonates, it won't just destroy the euro. It will obliterate the savings of 450 million people in a matter of weeks. 9 trillion euros. That's not the total debt. That's just the bomb. The active, ticking, mathematically certain explosive device sitting at the heart of the European financial system right now. And here's what nobody's telling you. This isn't a crisis that might happen. This is stage 3 of a 4-stage wealth destruction mechanism that has operated with perfect precision for over 400 years. The same mechanism that annihilated the British pound's dominance, that vaporized the German middle class in 18 months, that forced Nixon to abandon gold in 1971, and right now, in 2024, it's executing in Europe exactly as it has every single time before. There's a pattern to how monetary systems collapse. Not a theory, not speculation. A documented, verified, historically proven 4-stage pattern that has destroyed every major currency system in recorded history. Stage 1. A nation establishes a currency backed by something real, like gold. This creates confidence, trade expands, and everyone celebrates an economic miracle. Stage 2. The government faces mounting costs. Wars, welfare, political promises. Tax revenue isn't enough, so they secretly degrade the currency by printing more money and monetizing debt, all while promising everything's under control. Stage 3. The debasement accelerates beyond control. Inflation spikes, the currency loses value rapidly, and the system starts to crack. Stage 4, the final stage. The currency either collapses entirely or undergoes a catastrophic reset. Wealth held in that currency evaporates. The middle class gets destroyed. And the people who understood the pattern and moved their wealth to real assets before the collapse, they survive. Let me prove this pattern to you. First, Britain, 1797 to 1931. The Bank of England allowed the government to borrow far beyond its means. For a century, it worked brilliantly. Britain built the world's largest empire and established the pound as the global reserve currency. But the costs of war and empire became overwhelming. By 1931, Britain couldn't maintain the gold standard. The pound, once the world's reserve currency, collapsed. But the financial elite had already moved their capital to America. When the pound died, they were already positioned in the next power center. The British middle class watched their purchasing power evaporate, the pattern verified. Second example, Weimar Germany, 1919 to 1923. Facing impossible war reparations, the government chose to print money. At first it seemed manageable, but soon it went vertical. By November 1923, one US dollar was worth 4.2 trillion marks. A loaf of bread cost 200 billion marks. Life savings accumulated over generations evaporated in weeks. The German middle class was annihilated. But anyone holding physical assets like land, gold, or foreign currency not only survived, they bought up assets for pennies from desperate people. The wealth didn't disappear. It transferred. Third example, the US dollar and the Bretton Woods system. In 1944, the dollar was pegged to gold and every other currency was pegged to the dollar. It worked perfectly for 2 decades. But America started abusing the privilege. The Vietnam War and massive social spending led the Federal Reserve to expand the money supply. By 1971, there were 3 times more dollars in circulation than America had gold to back them. Nations started demanding their gold back. On August 15, 1971, President Nixon temporarily closed the gold window, severing the dollar's last link to gold. The dollar lost over 30% of its value against gold within 2 years, while gold itself skyrocketed 2,400% by 1980. The pattern executed exactly as before. Government expands, central bank prints, currency debases, system resets, and wealth transfers from currency holders to asset holders. Now, let's apply this exact pattern to Europe right now. The euro launched in 1999. A beautiful vision to unite Europe and compete with the dollar. For the first few years, it was a massive success. German exports surged. Spain and Greece borrowed cheaply. Investment poured across borders. Stage 1 executed flawlessly. But a catastrophic flaw was growing. You had productive, fiscally disciplined countries like Germany yoked to nations with persistent deficits and low productivity, like Italy and Greece. This structural imbalance is the core of the problem. Back in the day, countries like Italy, Greece, and Spain had their own currencies. The lira, the drachma, the peseta. When their economies got a bit shaky, they could just devalue their currency. This simple trick kept their exports cheap and their economies ticking over. But then came the euro. Suddenly, they were all locked into one currency. No more devaluing. No more printing their own money. No more setting their own interest rates. So what did they do? They borrowed and borrowed and borrowed. Between 2002 and 2008, things started to get out of hand. Greek government debt ballooned from 103% of their economy's size to 129%. Spain's private debt hit a staggering 227%. Portugal and Italy weren't far behind, with debt levels well over 100%. And here's how the bomb was built. When Greece borrowed euros, that money came from big banks in Germany, France, and the Netherlands. Then 2008 happened. The global financial crisis ripped the cover off everything. It turned out Greece's debt was way worse than anyone knew. They'd been using complex financial tools from Goldman Sachs to hide the real numbers. The markets panicked. Suddenly, the cost for Greece to borrow money shot up from 4% to over 35%. Portugal, Ireland, Italy, and Spain all started to look shaky. We even got a new acronym, PIIGS. All these countries were on the brink of default at the same time. This was the breaking point. The stronger northern countries and the European Central Bank, the ECB, had a choice. Bail out the weaker members or let them crash and burn, possibly taking the euro down with them. They chose bailouts, but the conditions were brutal. Greece got billions, but in return, they faced devastating cuts. Pensions were slashed by 40%, taxes went up, government workers were laid off, the economy shrank by a quarter, and youth unemployment hit 60%. The bailout money basically just passed through Greece and went straight back to the German and French banks that made the risky loans in the first place. But here's the crucial part. The bailouts didn't fix the underlying problem. They just bought time. And the ECB started doing something wild, quantitative easing. They started printing money on a massive scale. The ECB's balance sheet, which was about 1 trillion euros in 2007, exploded to nearly 7 trillion by 2020. That's 43% of the entire Eurozone economy sitting on one institution's books. For 15 years, the ECB has been in permanent crisis mode. This is not normal. So, where does the 9 trillion euro bomb come from? Well, you start with the 12.7 trillion in government debt, then add the 1.2 trillion in those target 2 imbalances that will likely never be settled. Add another 350 billion in bad loans just sitting on Italian banks' books. Then add the 4 trillion in pension promises that governments haven't budgeted for. When you add up all these interconnected, unpayable debts, you get to about 9 trillion euros. That's the bomb. And Italy is the fuse. Its government debt is almost 3 trillion euros, and its economy hasn't grown in 20 years. There is no realistic way for Italy to pay this back. They can't devalue their currency, Germany won't forgive the debt, and the Italian people will never accept the kind of austerity Greece went through. When the next recession hits, Italy will be in deep trouble. If the ECB prints trillions more to save it, inflation will skyrocket. If they don't, Italy defaults, and its banks collapse. And Italy isn't alone. Spain, France, Belgium, Portugal, Greece, they're all in the same trap. It's a doom loop. Weak governments borrow from weak banks who hold bonds from those same weak governments. The ECB prints money to keep everyone afloat, which devalues the euro for everyone. The 2010 crisis was never solved. It was just papered over with printed money. The debts are bigger now. The imbalances are larger. The only thing keeping it all from collapsing is the ECB's money printer. When this thing finally blows, it won't be a metaphor. Bank deposits could be frozen, just like in Greece in 2015. Capital controls could be imposed, and the euros in your bank account could lose a huge chunk of their value almost overnight. The fuse is lit, and the question is no longer if, but when. This isn't speculation. This is what has happened in every single monetary union collapse in history. Let's look at the patterns. The Latin Monetary Union, established in 1865, collapsed by 1927. Why? Weaker members debased the shared currency, and stronger members refused to accept unlimited losses. Sound familiar? Then there was the Austro-Hungarian Monetary Union, which collapsed in 1918. The empire printed vast sums of money to finance World War I, and the currency lost 84% of its value. And, of course, the Bretton Woods system, which fell apart between 1971 and 1973. This happened when America printed far more dollars than it had gold to back them. The pattern is perfect. The mechanism is mathematical, and right now, the Eurozone is executing the same script, approaching the final act. The only real question is, what will trigger the final crisis? It could be another recession that pushes a country like Italy or Spain into severe bond market stress. It could be a banking crisis erupting in France or Italy. It could even be political instability, with a new government refusing austerity and demanding either massive money printing from the European Central Bank or a full exit from the euro, or perhaps an external shock, like a new energy crisis or a trade war. Honestly, the specific trigger doesn't matter. The structural problem is already terminal. The system is mathematically doomed. The bomb is armed and ticking. So, what does this mean for you? If you're European, if you hold euros, if your savings are in European banks, or if your pension is denominated in euros, you are on the wrong side of a 400-year-old pattern that has never, not once, failed to complete itself. It means the euros in your bank account are not as safe as you think. They are units of a currency being systematically devalued to stave off a political crisis. Every month, the ECB keeps interest rates below inflation, is another month your savings lose purchasing power. Every month the target 2 imbalances grow represents a massive wealth transfer from savers in Northern Europe to borrowers in Southern Europe. Every month Italian debt increases while its economy stagnates is a month we get closer to the crisis that triggers the final stage. The historical pattern shows with mathematical certainty what happens next. The weaker nations will continue to accumulate unpayable debt. The ECB will continue to expand its balance sheet, essentially printing money to monetize that debt. Inflation will stay high, or even spike during the next crisis. Real interest rates will remain negative, punishing anyone who tries to save. Asset prices will inflate while wages stagnate, systematically widening the wealth gap. And then one day, most likely during the next recession, the crisis will become acute. It might start in Italy, it might be France. It could be a broader European banking crisis. When it happens, expect capital controls to be implemented immediately. You will likely find you can't move money out of your bank. Withdrawal limits will be imposed, pension payments will be cut, government bonds will default or be restructured. And the purchasing power of every single euro will collapse as the ECB prints trillions in a desperate attempt to prevent a complete systemic failure. Meanwhile, those who saw the writing on the wall and positioned themselves before the crisis hit will be in a very different situation. People who moved their wealth into hard assets, into property outside the Eurozone, into gold, or into currencies backed by commodity exporting nations with strong trade balances, they will preserve their wealth. This isn't a wild prediction. This is simple pattern recognition. The Latin monetary union collapsed because weak members debased the currency, and strong members would not foot the bill forever. The Austro-Hungarian monetary union collapsed because of runaway money printing. Bretton Woods collapsed because America printed dollars it couldn't back. The Eurozone is on the exact same trajectory. The ECB is printing money to finance the deficits of nations that have lost the ability to devalue their own currency. The mathematics are unchanged. The pattern is executing right now, right before our eyes. I know what you're thinking. European leaders won't let it collapse. The political will is too strong. They'll find a solution. That's exactly what British leaders said in 1925, before the pound collapsed. It's what German leaders said in 1922, right before hyperinflation. It's what American leaders said in 1970, just before they broke the dollar's gold peg. They were all wrong. History follows patterns, and these patterns don't care about politics. They care about math. And the math of the Eurozone is terminal. A monetary union with nations that spend differently always ends the same way. The weaker nations build up debts they can never repay, and the central bank prints money to cover it. This leads to currency debasement, a massive wealth transfer, and eventually a collapse or a radical, painful restructuring. There are no exceptions in 400 years of financial history. This isn't some future crisis. It's happening right now. The 9 trillion euro bomb is real, and it's being held back by the biggest monetary experiment in history. The European Central Bank's balance sheet has ballooned to nearly 7 trillion euros. That's not a sign of strength. It's a sign the final stages are approaching. If you can see this pattern for what it is, you have a rare opportunity. You can see the machine working before it finishes its job. You can move your savings out of the blast radius before the bomb goes off, but time is running out. The next recession could trigger the final acute phase. That could be next year, or it could be in 5 years. But the direction is clear. The debt is growing, not shrinking. The system is stuck in permanent crisis mode. And permanent crisis management always ends with a crisis too big to manage. While politicians talk about stability and the media focuses on daily noise, a systematic transfer of wealth is happening behind the scenes. The only question is whether you see the pattern clearly enough to act before the final stage begins, because it will begin. The math is certain, the history is undeniable, and our current path is identical to every monetary union collapse that has come before. If this analysis makes sense to you, if it changes how you see the European financial system, then I need you to do something critical right now. Subscribe to this channel, because this is just the beginning. In my next video, I'm going to show you exactly which European banks are most exposed, which specific assets are in the blast radius, and the 3 moves you can make right now to protect yourself. I'll break down the historical playbook for preserving wealth from past currency collapses and show you how to apply those strategies today. I'll reveal the internal documents and statements that prove the ECB knows the system is terminal and is managing a controlled demolition, not a recovery. And I'll give you the exact trigger points to monitor so you know when the crisis is about to go critical. But here was the problem. YouTube's algorithm won't show you that video if you just watch this one and leave. You have to engage. So hit the subscribe button right now and ring the notification bell. That's the only way to guarantee you'll get the alert for the next video in this series. If you found this valuable, hit the like button. It tells YouTube to show this to more people who need to hear it. And drop a comment below. Tell me what part of this shocked you the most. Your comment helps me and it helps the channel. Share this video with anyone who has savings in euros, a pension in Europe, or European investments. They need to understand this pattern before it's too late. When this bomb finally detonates, it will happen faster than anyone expects. You won't have time to learn this stuff after the crisis starts. You need to understand it now and position yourself now. By the time it's front page news, your money could already be trapped. Don't let that happen. Subscribe now and watch for the next video to learn how to protect yourself. The pattern is clear, the history is undeniable, and time is running out. Thanks for watching.